Good evening, everybody. Great to have you all on board. What are we going to do tonight? We have, I've actually changed the plan tonight. We were going to do a webinar tonight on due diligence, but we're actually not going to do that. And the reason for that is because I've just done a fabulous weekend on in Brisbane with the Ultimates, and congratulations to everybody who was there, and welcome, and hope you had a great time and all that kind of stuff. And there was a number of questions that came out of the weekend that I thought, you know what, Ian, let's change the schedule. So I've got Ian here to help me out.
Yeehaw, I'm here.
You're here. We're going to change the schedule because what we're actually going to do, rather than talk about due diligence on properties, what we're actually going to do is talk about how to work out what your capacity is, because it's very, very important to know what kind of strategy you can do from your current available position. Now, for some of you who are sitting there with not a lot of equity or perhaps not a lot of income and things like that, I don't want you to phase out here, because what we'll be talking about is how much available equity have you got, or how much cash reserves have you got, and whatever. So if you're sitting there thinking, oh, I haven't really got any of this doesn't apply to me, it absolutely does. Do not switch off, because you need to know this stuff, because you might be doing a joint venture with someone who is in a particular situation, who does have equity, who does have whatever. So everybody needs to know this, because when you're going out there and finding deals, there's no good getting yourself all hot under the collar and frustrated with a fabulous deal that you think you found, only to find out that you can't do it. There's nothing more frustrating. So what we need to do is to work out in a few people's different scenarios what they could do, and therefore what kind of strategy they can make happen. Because one of the big things is that people go out there and they buy a property, and they might even be able to get into it in the first place, but if they don't leave enough money for buffers in case something goes wrong, or they don't leave enough money for the strategy that they're actually going to do, then the deal's probably not a real good deal for them. And I see this over and over again. So I must absolutely congratulate Ian and his beautiful wife, Christine, because since the weekend, they have developed a whole spreadsheet for all of you to use, which makes it so, so simple. So I am so proud of these guys. They've done a fabulous job, and I'm actually going to hand you over to Ian to talk you through it, and talk through this whole process of how much can you buy, and how much do you need in reserves to make it happen, and the whole process of capacity, because this really nails down for you what kind of deal you're going to do, what kind of market you can go to, even what kind of price point and what area you can go to find a property that you can do that kind of deal to in that kind of price point. So this is really, really important webinar. So I'm going to hand it over to Ian, as I say, and he's going to step you through this magnificent spreadsheet.
Thank you. I might mute you then.
Oh, thanks. Am I noisy?
All right. So coming off those boot camps, there's always that section there with the action plan. If you remember the action plan section there, and there was always those calculations at the back end where, I know as a teacher when people are getting it and people aren't getting it. In the scenarios of those boot camps, I know about only 30% of people get the numbers, and so a couple of you get lost. It's really important to do numbers. It's part of your game, and it's part of your business. So if you can get tools to help you out, that will be good. So when we were driving back from Brisbane, I had the thought pattern. It was going through my head, and I go, what are we going to do? Now, as per usual, from a teacher perspective, the best things that I learn are from the students. And during the boot camp, once someone said, look, could you do a webinar on this? I thought, what a brilliant idea. So I was thinking about the lesson plan on the way home, and I thought, let's just structure this like I would do in a normal TAFE session. And it's been many years now, so let's hope I can get you through this one. So let's start with looking at your existing portfolio, and knowing that I came from that scenario. The first thing you need to do is have a financial health check. Now, it's not necessarily the absolute first thing to do, because if you can go through this process before you do the financial health check, it will make the strategist from ILN's job really easy, because you'll know exactly what you can do with the amount of money that you think you can do. Now, you might have some surprises from them, and they'll say, no, we can do better. But you also need to know that your limitations are in certain areas. So that's an important part of it. Do you have a negative geared property? So, like myself, we had 7 properties when we finally decided to make a move and do well. And out of our 7, only one of them was bought after the boot camp. Was bought 1 week after the boot camp, and 6 of them had to be sold. We were negative geared, and we knew they had to be sold. In the bottom of our hearts, we knew, but they were trophies. So we thought, oh well, let's sell them down because we'll be in better position. Now you might turn up to a financial health check with the strategist, and they say, look, hang on, we could do so much better for you if you didn't have that property there. And you've had that property for a while and it's hurting a little bit, and you've tried to find the money for all these years, and you go, I don't want to sell it. I don't understand why I have to sell it. And essentially it's hurting you. You take our situation. I had a $96,000 income at the time. We were 36 grand negative, and thankfully one of them was positive, because otherwise we'd been minus 56. So minus 36 negative. Take that down to, take 96 off 30, take 36 off 96, we're down to 60. Take some tax off that, we were down to probably 35 grand is what we had to live off for the whole year, and that really hurts. One point I will make, is that I'm not watching the questions at the moment. I really want to get through this so that we've got a really good webinar for people to learn this whole strategy when we're talking about it at the boot camp. So, we talk about it at the boot camp, and then we go, no, okay, so you didn't quite get it there. Let's go back and watch the webinar. This is also for you to go through the process. Every time you need to go back to it, you can just click on the webinar, go to that point where the spreadsheet is being used, and you go, okay, remember how to do that. The next point is, have you been told that your serviceability is being affected by your investment properties, which is what I just talked about? You could be far better off without them. So for me, we were minus 36 with 7 properties, and we were positive 20 with 1 property. So by selling 6, we were much, much better off. Are you emotionally attached? The biggest one for us in our property was our first home that we, 2 kids were brought up there, and I did my first big renovation on it, and it was a beautiful area, and all the excuses that were coming up. And at some point in time, we moved out of it and made an investment property, and that was $22,000 negative out of our 36. So for us, we really had to look at it in a way to say, well, it's the one that's hurting us. It needs to move. So they all moved. And you know what the return on equity is? So if you go down to your download section on the Ultimate website, you can do the calculation. Now, when I talk about our original home being $22,000 negative, even though it was $22,000 negative, I was getting a 17% return on the equity I had in that property. Now you say, well, if I sold the property and I went out and then I put that money in the bank, where else am I going to get a 17% return? Although I was getting a 17% return, although it was 22 grand negative, it had to go because it was stopping us from moving forward. And have you done your opportunity cost analysis? Again, on the download section, there's a webinar also on opportunity cost analysis where there's a spreadsheet and you can put it down. So the opportunity cost analysis is what's my opportunity to revalue this property and take that money and invest it somewhere else versus selling the property, paying the capital gains, paying everything that needs to happen, and take the cash and do something with that cash as well. And that's also a webinar and a download that you can do. So what can I afford to buy? That's the big question, because this is the thing with, you go and do your financial health check and they say, look, we want you to go and buy a property. You could probably afford this much. And that, they might say you can afford a property around 300. And you'll say to them, well, I went and saw a mortgage broker and they said I could afford something at 500. Absolutely, you could afford something at 500. But what the other mortgage broker hasn't taken into consideration is that part of your cash that you need to do the strategy with, has to be put aside. So, they'll say buy 300. That's because they know that you're going to do a renovation or a strata or subdivision. The other broker's just presuming you're going to go out and buy a house and plan, an off the plan land purchase, and it's not going to be worth anything other than what you've bought it for, and you've paid a marketeer for it. So the first thing I'd like to explain to you, which I explain to a lot of people, especially the students we work with personally, is the puppy dog theory, or the kid in the lolly shop. What can happen to DIMTNA students is that you see so much ability to strategize and do what you can that your focus, it gets lost. And the puppy dog theory is, you've got one of these little racy fox terriers, and they just run around the place. And you put them in the back. You decide that the fox terrier wants to go out to the countryside to have a look at some farm and chase some sheep and do some stuff. So you put him in the back of the car. And for 2 or 3 hours that you're driving, this fox terrier is running side to side, and he's looking at the trees, and he's barking at something else, and then he's going across and looking at cars, and then he barks at the sheep, and he barks. And by the time you've driven 2 or 3 hours, he's lost all his energy. And you open the car door when you finally get there, and the thing's asleep on the floor because he's lost his energy. The same thing with the kid in the lolly shop. You've got all these ability to choose all these lollies, and you want to choose this one, you want to choose that one. The problem with both those theories is that when something good sits up and plonks itself right in front of your face, your energy is so scattered that you actually don't know which one to choose because you haven't focused on it. I always say to students, pick 3 strategies and pick 3 suburbs to do it in, and become experts in those 3 suburbs. That will give you technically 27 options, because on one property you choose, you could do a subdivision or a renovation or a construction development, right? Now, you might say, okay, but that's only 3. Well, if you could go in and on one job, you can do a renovation and a strata title and a construction, which one of Dipner's students doing right now, actually. If you could fit all those 3 strategies into the same property, you will do really well, because there's no in and out costs for multiple strategies. You got 3. So, Brad, who you may have met already, who's actually doing a bit of speaking now with Dipner, he says, stack your strategies, stack them as many as you can on top of each other. You need to know what you can afford, because you don't want to go out and buy a $500,000 house and then find that you can't afford to do a renovation. You can't afford to do the strata because you spend all your money on the in costs, like stamp duty and your legal costs and the other costs that go with that, and your deposit. You've got nothing left to do anything. And the analogy I'd give you here is, if you said to my 8-year-old daughter, go down to the shop, here's $5, I want you to buy some lollies and some bread and milk. The chances that they're going to come back with bread and milk are very slim, because all they heard was lollies. So for you, you've got to be wary of the fact that you need to leave enough money to buy the bread and milk and the lollies as well. Now, the interesting thing about what you can afford here is it's the chicken and egg theory, because which comes first? Do I pick a price and then work out where I can afford it, or do I pick out and work out how much cash I've got to work out the buy price? Now, we've set out a specific formula, which we did in the action plan, which will give you a point of reference to say, okay, well, I can afford to buy this much, this style of property at this price, and I still have enough money for my deposit. I still have enough money for my excess costs of stamp duty, and I still have enough money to do my strategy and interest cost as well, if you need to factor that in too. So where do you start? Well, you need to know what your credit card debts are and other debts that are associated to you, because that's going to be part of the calculation. The next thing you need to know is you need to know your available cash and your cash equivalent positions. So when I say that is, how much cash have you got in the bank or, under the mattress? And also, do you own assets that are lying around that you're willing to sell? So shares is one of them. But let's say you had an old motorbike, and some of you from some of the Quantums may know Jack. And Jack recently sold his motorbike, and I think he might have got $10,000 or $14,000. And he went and bought a little cheapie that was cash flow positive. He has potential to do stuff. Now, he was willing to sell that motorbike and take that $10,000 and invest. Now, when it comes to this, knowing about how much cash and cash equivalents you have, if you're not willing to sell your motorbike, you can't put it in there. But I would suggest for the short term, and like Dipner said to me as well, you sell it now, and in 10 years' time, make your money and you can buy whichever one you want. And that's what Jack said to me. He says, I sell my motorbike now, I'll make my money, in 10 years' time, I'll buy whatever Harley I want to do. Next, you need to know the available equity that's in your home and your investment properties. So knowing how much money you can actually pull out and take somewhere else, so that you can invest it in property, hopefully post Dipner as a positive geared scenario, or chunking if you need to do that. And then you need to know the cost of the strategy that you've chosen on the property you're going into. And the deposit and purchase cost is what I talked about up there. So you need to know about the deposit and purchase cost. So you need to know strategy, You need to know your deposit costs, and you also need to know the costs that are going to cost you to get into the deal. So you say, I'm not good at maths. Now, I would say you're not good at maths is because the way they taught you. Everyone is good at maths. You just need to do it differently. You know, I sat in our office today with a student, Kelly from Kellyville, and we went through some numbers in there, and I was doing numbers on the side and drawing the house and working out the mortgage and then working out if they sold part of it, what it would end up. And Christine was sitting on the computer doing a spreadsheet, working out her numbers. And Christine ended up with 68,000 and I ended up with 68,500. So just teach yourself to draw pictures and work around that. You know, I made my name in TAFE by working with students who were considered people that couldn't learn maths or English. When I pulled them to the side, instead of teaching them 2 by 2, I would say, draw 2 boxes. Now draw another 2 boxes. Now you've got 2 sets of 2 boxes, that's 4. And if that's what you need to do, then do it. Find a way that works for you. We've created this spreadsheet so that you don't have to do that. Now, if you're not good at maths and you can find people that will help you through this process and create spreadsheets for you and it works for you, go for your life. The thing about creating spreadsheets is you have to know what you're trying to achieve. And by explaining to someone how to put it into a spreadsheet, you will actually know the background theory behind the spreadsheet, and it will make sense to you and it'll make a big difference to you moving forward in this business. Now, the first thing you've got to do, Christine's coloured it for you. So this was created by my wife. So this is me sitting by my wife. I'm a big picture person, right? And Christine's a detail person. So I sit by Christine and I go, this is what the information I want to know. And she starts putting it together. And then she says, all right, well, how do you want to do that calculation? And I look at the boxes she's created and I go, that box minus that box plus that box equals that box. And that's what she does for me. And she's really great on spreadsheets. She's the bee's knees. So, okay, the first thing you need to do in here is your credit card debt. Now, you might say that my credit card debt isn't, I've got 20 grand, but there's no debt at all on it. For the purpose of this exercise, just put in what you owe on it, because at the moment, most banks will actually look at the 20 grand, even if it's down at zero. But let's do that. Let's put, for example, we'll put $10,000 in there. Actually, what I might do is make it bigger for you so that you're not straining on there. All right, hopefully that's better for you. So we put $10,000 in there. That's one of my liabilities. You may have other loans that you owe family or friends. If it's not going to show up for a credit search, don't put it in, unless, of course, you need to pay them back very soon. Now, what are your assets? Are you willing to sell? This is the point. Now we're on to the green section. Are you willing to sell some of your stuff? You know, you might have a you might have a car there that's sitting out the back, and it just, you might have to spend $1,000 on it, and you could sell it for $11,000. So let's say that you can spend that $1,000, and we'll put $10,000 in there. You might have your motorbike sitting out the back, and it's a trail bike. It's a half decent trail bike, so let's sell that for $5,000. Now you might be able to get onto eBay and sell some personal effects. Can you sell some jewelry, a wedding dress, a wedding ring if you don't need it anymore? Who knows? You could sell lots of stuff. So, I won't put anything in. Now, cash on hand, how much have you got sitting in the bank? You might say, well, I've got $4,000 sitting in the bank. Planning equipment. Brian Dipner's husband had a $20,000 excavator sitting out in the yard for about a year. So, it was worth $20,000. So you might put $20,000 in there. And to make Dipner happy, you might have 10 grand's worth of shares that you're willing to share. Willing to share, no, you can share it with her, but she won't take them. Willing to sell is what I meant. So out of that, we've got $49,000. So 10, 30, 40, 49,000, okay? Now, the calculation of these liabilities already happens in the spreadsheet for you. Now you go, do you have your own home? Well, if you don't have your own home, there's nothing to enter. Now remember, the number one rule here is, if you are someone who's starting with nothing, you still need to be able to put this together so you can show joint venture partners what their availability is on the deals that you find, okay? And once you've made your money, then you need to work out what you can do as well. Okay, so at some point in time, you're going to say, well, do I own my own home? You go, yeah, I do actually. So let's put a value on my home of $400,000, the current market value, and then you put your current mortgage in. So you say, rightio, my current mortgage is, I'm going to say so that we've got some money available. $280,000 is what my mortgage is on my $400,000 property. Now, this square here where it says, what is the likely loan to value ratio? It's very difficult for some people to find that out. Your serviceability, and you may need to ask your investor loan strategist what it is for the benefit of where you are right now. If you've got no job, you're not going to be able to get a loan. That's essentially where you're at. And so many students, I say, go and get a job, get it for 6 months, and your life will be much easier for you to be able to work forward and get loans. If you do have a job and it's low paying, well, you're going to have reduced loan to value ratio. So you might be only able to lend 50%. Once your income starts getting up at reasonable above the average, well, you might be able to get 70 and 80% loans. If you've got really, really good income, you'll get 90%, and even better, you'll get 95%. So it may be worth on your own home going to 95 if you can do that, so you can extract as much as possible. So let's just say for the argument here that we can do an 80% loan, so I'm just above average person, and it will then calculate that in my loan, I've got $400,000 in the property value. The loan that I've currently got is 280. Now at 80%, I can tell you because I can do the maths in my head. At 80% on 400, I can get a loan at 320. But this automatic, so the difference between 320 and 280 is $40,000. This automatically calculates how much available equity I've got in that property to draw upon to go off and use for investment purposes. So then I go, rightio, so I've got some properties here. So let's say that my first investment property is worth $300,000, and that I've got a mortgage of $200,000 on it. And on this property, I can also go and revalue and get a loan at 80%. My next property I've bought, it's pre-Dimpner. Now this property you probably bought a while ago and you've paid it down. The next property I went and bought a house and land package and I paid $440 for it, and I got a loan on it of so the property value, so it's not what you paid for it, it's the property value. So let's say that we did pay $440 for it, but it dropped to $400,000, and the loan on it now is $380,000, and I can get an 80% loan. Now in this one here, you can see the right-hand column says that with this property, because it's dropped in value and I've got a loan at 380, if I went and got an 80% loan, I'd actually have to give the new bank back $60,000. So I've gone backwards. So you have to be wary of that when you're doing these. And this is where the strategist is going to say, all right, we need to leave that one alone and let's not talk about it. Okay, so let's say that I did finally join Dimpner and I bought a $500,000 property, and it's worth $500 now because I manufactured some growth. So I paid $300 for it. So that meant the loan was $240 for it. And so I'll go $240,000. And how come I've got a negative number there? That's interesting. 500,000, 240,000. That's interesting. We might have to fix that one. Let me try it up here. 500,000. Now remember, this is a spreadsheet that was created and finished 2 hours ago. 240,000. Yeah. Okay, there's an issue with that. I'll get that fixed for you. With this one here, let's just say that I'm going to get this one out of the way. I'm going to delete that and I'm going to delete that. So at the moment, we've got 100K. So available equity in our 2 investment properties that I've got in here is $100,000. Now, out of that $100,000, what am I likely to use for a safety buffer? What am I comfortable with if something happens? If I lose my job, if interest rates go up, if while I'm doing doing a property, the strategy on the property, I get a left field thing from the council and from the electricity people, and they say, well, you're going to need to upgrade the transformer out the front of the property. So what are you comfortable with? Now, no one can tell you what you're comfortable with. So you might say, well, rightio, for me, I might be comfortable with $20,000 sitting there as a buffer in case something goes wrong, in case I don't have a tenant, in case I run over for interest prices and stuff like that. So now from all of that, and I'm going to fix this so that I'm actually going to fix this so that I can actually use 100,000. So see down the bottom here, out of doing all those calculations up above of what I owe and all the extra equity that I can get, you can see that after a safety of buffer of $20,000, I've now got $159,000 available. Now I'm going to increase that so that I've got $100,000 available, so it makes it simple to work with the numbers. So just let me quickly check some questions and see whether we've got some questions here. I've gone to the tiny URL cell, downloaded the spreadsheet, but it is blank, nothing like what you're showing on the screen. It doesn't even have cells marked in the spreadsheet. Has anyone else got the same problems? All right. Just check that the tab down the bottom is press sheet 1 and that you are at the top left-hand corner. And if that's the case, I'll try and fix that. Are these property loans interest only or principal and interest? It doesn't matter. It doesn't matter whether it's principal interest or loan interest only. For me, my investment properties are all interest only. I'd only be paying principal off on my own home when I make chunk deals. That's the only way I work. Okay, you need to put the LVR in, of course. Look at you guys. You're on top of me, hey? Just don't like the LVR of 0%. Spreadsheet downloaded and fine. So you just got to, it might be a system problem with your computer or your version of Excel. And this is created on the latest version of Excel. So thank you guys. So let's say 500,000. And if I put in a loan, 500, 8 sixes, no, 8 times 5 is 400. So if I put a loan in at $400,000 and I put my, thanks guys, what an idiot. So obviously you can see that if I took an 80% loan against my current mortgage, I haven't got any growth in it, so I've got nothing available. All right, so now we've come down here. I said I want $79,000 buffer just sitting there on the side because I want to make sure I've got no risk at all. I don't get into trouble, which means that this yellow square here is $100,000. Okay, so we've got $100,000, so we need to move on to the next step. And the next step is, what's the type of property? What's the amount? What's the property I can buy? And what strategy do you want to use? So the first thing you've got to do is, I've been to a boot camp, I've seen other students doing stuff, and I've decided on this type of strategy. Now, you might say, okay, well, I want to do a reno. As you all know, I cut my teeth in renovation, and it's not my favorite strategy. It's one of the hardest strategies. So I would say to you, well, okay, if you want to do a reno, I've put some rough indication of what you would spend if they were really simple. Now, remember, I did a subdivision. One of my first subdivisions, I had allowed $60,000 for the budget, and it cost me $240,000. Okay, so if you don't know, start asking some questions around the forum and asking around them. So cosmetic reno. So cosmetic reno is where you go into a renovation. You don't change any tiles. You don't put a new kitchen or bathroom in. You just simply put new handles on. You paint the place. You fix the garden up. You don't do anything major. I would say that you need to spend $5,000 to $30,000. If you've never done anything before renovation, then go the high end so that you know what you're doing, or pay someone to do it who's going to tell you how much it's going to cost. A code accessible renovation is a renovation where you go into it. You might you go to a private certifier to get approval. You open up a couple of walls, and you might put a new kitchen in, and you retile the bathroom, and you just spruce it up a little bit. 30 to 75 is what you're going to need there. And then you've got a structural renovation. That's a full-on renovation where you're knocking the back of the house out and you're going up one story, you're adding bathrooms and kitchens and doing the whole lot. You're going to need somewhere between 75 to 200 if it's a big structural renovation. And I've worked on a structural renovation that cost $1.6 million. So, it's full on. Now, do you want to do a strata title? If it's a paper shuffle and there's no work to do other than the surveyor and the legal person putting it all together, it may cost as little as $30,000. A simple subdivision, so if you're doing a corner block or a dual lot single title where you're just lifting title, allow $50,000. If you're doing full-on subdivisions, well, it's obviously going to cost you more. A simple council application to accompany a subdivision and a strata may cost you about $10,000. Engineering, if you need to do engineering for the concrete driveway for the subdivision or your development deal. Development contributions, they vary. Now, a development contribution is the contribution you give to council as a gift because you're a developer, because you've created an extra lot or an extra dwelling in their suburb, in their council area. So what that gift is, that covers for the extra rubbish bins. It covers for the extra garbage truck they need to buy over a period of time. Park benches and new lawns in the parks and all that sort of stuff. That's what it goes to. Now, development contributions, which in Queensland they're called headworks. In New South Wales they're called Section 94. In other places they're called council jet contributions. In Victoria, some areas are $600. In Queensland, Sunshine Coast is $28,000. So you're going to need to know, if I'm creating 2 or 3 extra subdivision lots, I'm going to have to, 28,000 times 2. So just for the sake of the argument, let's say we're going to do a cosmetic renovation. It's going to be $30,000 worth of cosmetic reno. So we put in that $30,000 and all of a sudden it calculates the $30,000 down the bottom. I might do it differently. Let's say that I'm going to do a renovation of $10,000 and that I'm going to do a simple strata, and because it was in a regional town, it was only going to cost me $20,000. So it accumulates down the bottom here to $30,000, and it automatically allows 3% just in case there's some overruns for whatever reason. The tiling fell off the walls, they had to retile on the cosmetic and that sort of stuff. So we now have a total of 33, and you can see up here we had 100. We've now spent 33. Now we've got $67,000 to be able to work. Now, for some people, you may end up in a place. So let's just say for this contribution, for this this strategy, I've decided I'm going to do a cosmetic reno. I'm going to do a strata, and I'm going to do a subdivision that's going to cost me $50,000. And then I'm going to go off and I've got some council contributions at $28,000. All of a sudden, I've got a red figure down here. Now, as soon as you hit a red figure, that means you've run out of money. Okay, so what it means is that if you want to do this deal, you're going to have to find a joint venture partner, and you're going to have to cut some costs by $18,000 odd, right? There is $10,000 of contingency there. So you're going to have to do a JV with the owner. You're going to have to do a JV with another student who has the availability of cash for a deposit and maybe serviceability. So be very wary, because some of you may run out of money at that point in time, and you go, well, hang on, I haven't even bought the deal and I've run out of money on strategy, and I don't even know what I can afford yet. So let's get rid of that again. And we're back to 33. So now we've got, after we've allowed $33,000 and we've put it to the side, okay, so we bought our bread and milk and we put it to the side. Now we're going, rightio, we've got $67,000 available. Now in here, we've got 67 available. We've already got our available working equity. So this is just a recap of what we've done above. Our strategy cost said was 33,000, so we got 67. Now we have to say our likely LVR on the property purchase. So the property that we are purchasing, how much is it going to cost us? What type of loan to value ratio will I get? Now, above here, we used 80%, so let's just stick with 80%. Now, if I put 80% in there, it automatically tells me my purchase price is $257,692. I can afford to go and buy this property here, and with buying that property, I'll have enough for my 20% deposit. I'll have enough for my costs, which is 6% of the purchase price. So that 6% caters for stamp duty, for my legal costs, for my trust setup, any other mortgage costs that come along, right? And then I still have $33,000 put to the side to do the strategy I can do on the deal. Now, you can see that I can afford $257,692. If I buy over that price, I'm going to run out of money. If I buy below it, well, I'm going to be okay. Now, just let me look. Spreadsheet is an XLX. Yeah, that's right. So it's an XLSX. So you need an XLSX. Why are we calculating the LVR on my investment properties? My total property value is 1.25 and mortgage is 1.05. After likely LVR of 80%, I'm only left with 5,500. That's because your properties are not working for you. So just let me do that quick calculation. 1.25 times 0.8 is 1 mil. So you have my calculation is, so someone's saying I've got $1,250,000. So this is take it, well, at the moment I'm not talking about the spreadsheet, I'm just talking about a question here. I times that at 80%, and that's a loan of $1 million. So that means you've got your loans are more than 80%. So if you could only get an 80% loan, that means that you can't afford to go and invest somewhere. So that's why I had to look at my portfolio and go, one, I've got negative geared properties, and two, if I went and got 80% loans, I'd actually have to pay the bank back. So you may have to look at your properties, and that's where the strategist will look at your properties and go, you know what, you're going to have to sell that one and sell that one and sell that one, and you're not going to want to, but that's life if you want to move forward, and that's what we had to do. And we had to lose money to be able to move forward. Okay, so now we've got that there, right? That was at 80%. So we can only estimate what our likely loan to value ratio is going to be. You won't really know until you sit down with the strategists and brokers of investor loans, and they will be able to tell you. But just to give you the power of serviceability, if I went into this property with my $67,000 and I could take my loan to 90%, my value of the property that I could buy jumps up to nearly $420,000. So I'll do that again. If I went at 80%, I could buy a property at 260, and if I went at 90%, I can buy a property at 418. And the reason that is because now we only need a 10% deposit instead of a 20% deposit. So that's a really important thing to know. For some of you, you may only be able to go to 70%. So at 70%, we'll have to buy a property at 186. And for some, and retirees are in this boat, you may only be able to borrow 50%, which means you're going to have to go and buy a property at $119,000 and do a cosmetic reno to it. Now, you might say, oh, 119, I can't buy a property for that cheap. Well, I've seen a platinum last year buy a property at $16,500. They spent $55,000 on the property, and it was worth $175 at the end. So they got all their money back plus another $75. So they are doable.